Hello everyone. Today, we will be studying section 4.5, Issuance and Circulation of Central Bank Digital Currency. From the course Development of Digital Currencies, the issuance and circulation of central bank digital currency is not merely a matter of electronic bookkeeping. It is supported by a carefully engineered, systemic framework. This lesson delves into the full life cycle of CBDC, from creation to entry into economic circulation, showing how it simultaneously upholds monetary sovereignty, financial stability, and technological innovation, and providing the core logic needed to understand digital financial infrastructure. We will study the CBDC issuance and circulation process from four perspectives: core architecture, value carrier, technological support, and design principles. By the end of this session, you will be able to 1. Grasp the end-to-end process of CBDC issuance and circulation. 2. Distinguish between account-based and token-based models. 3. Understand how privacy protection and system security are balanced. Let's start with the framework of the system, the two-tier operating model. Why a two-tier system? Why doesn't the central bank issue CBDC directly to every individual? The answer lies in efficiency and risk considerations. 1. Central bank tier, issuance hub and master ledger manager. As the sole issuer in the CBDC ecosystem, the central bank performs three core functions. 1. Currency issuance. Digital currency is generated within the central bank's core system, essentially serving as a record of the central bank's digital liabilities. Each unit of CBDC carries the central bank's credit backing, ensuring its legal tender status and stable value. 2. Ledger maintenance. The central bank maintains the authoritative ledger, tracking the total supply of CBDC and its allocation among commercial banks in real time, providing a comprehensive view of currency circulation. 3. Rule setting. It leads the design of issuance rules, technical standards, and compliance frameworks to ensure alignment with regulatory requirements such as anti-money laundering and counterterrorism financing. 2. Commercial banks. The hub for circulation and user services. Within the two-tier system, commercial banks play a crucial role as intermediaries. 1. Exchange and distribution. They convert reserve deposits at the central bank into CBDC at a 1-to-1 ratio and distribute it to individuals and businesses through counters and digital channels, bringing CBDC into the economy. 2. Wallet operations. They set up and manage digital wallets for users, carry out strict identity verification (KYC), and create the gateway for user interaction with CBDC. 3. Transaction processing. They handle transfer requests between users, monitor transactions in real time, and intercept potential risks to keep the payment network smooth and secure. Now that we've covered who manages the system, let's turn to the question of what form this money actually takes. There are two mainstream technical models. 1. Account-based CBDC, balance management tied to identity. 1. In this model, users open verified accounts with a commercial bank or the central bank. CBDC exists as a numerical balance within these accounts. Transactions are completed by verifying the payer's authorization and adjusting the balances of both parties, relying on a centralized ledger system. 2 key features. 1. Advantages. It seamlessly integrates with the existing banking regulatory framework and supports targeted monetary policy tools, such as precision credit allocation. 2. Challenges. User privacy is limited by the centralized identity system, and the system must meet extremely high standards of fault tolerance. 2. Token-based CBDC, value units secured by cryptography. 1. In this model, CBDC takes the form of encrypted digital strings, or tokens. Users prove ownership and authorize transactions with private keys, enabling peer-to-peer transfers. 2 key features. 1. Advantages. It supports controllable anonymity in transactions, especially for small payments, while reducing reliance on intermediaries. 2. Challenges. It must balance privacy protection with regulatory compliance, such as anti-money laundering traceability, and users are responsible for safeguarding their private keys to prevent asset loss. A typical example is China's digital yuan, Issuance, which adopts a token-based UTXO model with a tiered wallet system to achieve anonymity for low transactions, traceability for high ones. Basic wallets can be opened with just a phone number and allow for small, anonymous payments, while advanced wallets must be linked to a bank account to meet regulatory requirements for tracking larger transactions. Students, whether it's a two-tier operating system or a token-based model, both require strong technological foundations to function smoothly. Let's look at the 3 core technologies. 1. Distributed Ledger Technology, DLT. Selective enablement. Its application scenarios include 1. Wholesale domain, used for interbank large-value settlements, such as in cross-border projects like mBridge, to improve settlement efficiency and reduce counterparty risk. 2. Retail domain, focuses on central bank control, often adopting partially decentralized or private chain architectures to strike a balance between performance and privacy. Its core value lies in providing tamper-proof synchronized transaction records, enhancing transparency and collaboration across institutions. However, it must overcome challenges such as performance bottlenecks and energy consumption. 2. Cryptography, the security backbone. 1. Digital signatures. Ensure transaction authenticity, integrity, and non-repudiation, a core feature for token-based CBC. 2. Data encryption. Protect the confidentiality of transaction details and user identity. 3. Dual offline payment technology uses near-field communication, NFC, and encrypted chips to enable secure value transfers even without network connectivity, expanding payment capabilities to offline scenarios. 3. Smart contracts. Programmable circulation rules. Functions enabled by smart contracts include 1. Restrictive fund usage, such as directing poverty alleviation loans to designated merchants. 2. Automatically executing rules, for instance, rendering consumption vouchers invalid once they expire. 3. Supporting complex transactions, such as delivery versus payment, DVP, in securities trading. 4. Assist regulatory compliance, automatically reporting large value transactions to authorities. The main risk lies in ensuring the security and legal enforceability of the code to prevent systemic risks caused by potential vulnerabilities in smart contracts. Finally, let's look at how these design principles are put into practice in the actual circulation process. 1. Balancing privacy protection and controllable anonymity. 1. Tiered wallet system. Small value transactions focus on verifying the validity of the token rather than the user's identity, while high-value transactions require strict identity verification and traceability. 2. Data segregation mechanism. Transaction data is managed by the central bank, while identity information is stored by commercial banks, keeping sensitive data separated to reduce concentration risks. 3. Legal traceability. With proper judicial authorization, illegal activities can be tracked on-chain through key-based tracing technologies. 2. System resilience and continuity of circulation. 1. Redundant architecture. Core systems are deployed across multiple locations and nodes to prevent single points of failure. 2. Dual offline payment. Guarantees basic payment functionality in extreme scenarios such as earthquakes or network outages. 3. Quantum encryption preparedness. Researching encryption algorithms that can resist quantum computing threats to secure future-proof protection. 3. Interoperability, the key to ecosystem integration. 1. Domestic connectivity. 1. Enable real-time exchange between CBDC, bank accounts, and third-party payment platforms such as WeChat Pay and Alipay. 2. Standardize merchant acceptance to support one code for all QR payments. 2. Cross-border interoperability. 1. Participate in multilateral initiatives like the mBridge project to develop unified cross-border payment protocols. 2. Pilot trade settlement scenarios to reduce exchange rate risks and settlement delays. Students, today we have unpacked the issuance and circulation mechanism of central bank digital currency, catching a glimpse of a sophisticated, secure, and intelligent prototype of financial infrastructure. However, this is only the beginning of the story. Once the system is fully established, it will function like a vast digital expressway network, injecting powerful momentum into the future digital economy and bringing about transformative changes and opportunities beyond measure. At its core, the issuance and circulation of CBDC represent the extension and reconstruction of national credit in the digital space. CBDC is not merely an upgrade to payment tools, but a fundamental reshaping of financial infrastructure in the era of the digital economy. Finally, please complete the following exercises. That's the end of today's lesson. See you next time.